Hey, everyone. Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
And I'm Will.
Yo, guys. What's up with low rates and people still having cold feet? It's like this 1 foot in, 1 foot. What's that song they used to do? The Hokey Pokey?
1 foot in, around.
1 foot out. Yeah, put your low rate in and then you take it right back out. So, like, this low rate thing. We got like low rates hitting the market, but then like, a couple weeks ago we talked about all these people saying, oh, I'm going to sell my house the next year or the next 2 to 3 years. And then you have this new survey that comes out that says now 90% are reluctant. And you're like, wait a minute, this is like, it's like whiplash. It's whiplash around here. So we're going to kind of cover both topics because mortgage rates is on the top of most people's minds. It's looking around real estate and mortgage right now. But we also have to talk about mortgage demand and then also people having cold feet. So do you guys like Dave Ramsey?
You know what?
Like dislike.
I was surprised at what he mentioned in the article, and for his point of view in that he looks at finances, I thought was pretty interesting.
Okay, so we haven't talked about Dave Ramsey here before.
No.
I know you guys, we don't like sit around and talk about him. Like every once in a while we'll share something that maybe he said. You're like, oh, okay, that's a good idea or whatever. But or not. Yeah. And again, that's just because of, everyone's allowed to have their own opinion, right?
Of course.
So we're going to start with that today, though. So Dave Ramsey says with Realtor.com, says pausing saving for your future to buy a house now, according to Dave Ramsey.
I know. That was pretty wild.
So this is from the guy who, he's talking all the time about like pay off debt, carry no debt, pay cash for everything, save money, and invest money.
Yeah. That's right.
But pause saving. Now, there are some stipulations, so let's not let the headline just tell the whole story because it's clearly not the whole story. So as home prices rise, so do down payments, making it increasingly difficult for potential buyers to invest in real estate. And we find ourselves in a point in time where saving for that down payment, as well as getting your debt-to-income ratio to work to qualify, is most people's challenge right now. Yeah. And he seems to be meeting the moment where it's at. What do you guys think?
Yeah, I think he laid it out pretty clear. I mean, it's definitely a short-term play, not something that, you're going to do forever. But if you strategically are able to pull it off, then, you're going to be in a good position. I just think the way that, it came out, it's like, oh, like completely stop saving. No. It was more like, hey, like take this period of time to kind of just reallocate your funds that you're already putting towards your savings account, but rather just, put them towards another savings account for your down payment. So I think it was a smart idea, but the way that they break it down actually gives you more context.
Yeah, no, I mean, Dave Ramsey, come on. Who would ever thought, go get in debt, right? Go buy a house. Usually you want to pay it all off. No, he's not always all about that, but it is pretty cool to actually see him be a little aggressive with this. He's very conservative. He's all about just, if you're going to travel, do not travel if you're broke and you need to pay off some bills. Is it a need or a want? And if it's a want, just ain't going to happen right now. So I do like that he just says right here, buy a house with your retirement savings. Essentially, I like what he's stating, put your savings for your retirement on hold because there is power in actually owning a home. And we already know statistically proven people who own a home, the percentage is really high where they're going to be financially well off when time for retirement comes. So I like that. And he's not saying, again, he's in the article, I like that it specifies that you're not to go and do this over a certain amount of period of time. He's strategically planning, you got to do it within a year, 2 years. That's good. You're probably going to have this feedback from your financial advisor, this pushback, right?
No,
what do you mean? You're going to take away from me? But, a lot of times, Andy, what we see most of the time when our clients come in and we work with a lot of military. They go into their TSP, right? And when you ask them, can I get a quarterly statement? They're cool to provide that, and then when you see what they're doing, there's no aggression there. And you're like, well, wait a minute, man, they're like Brian's age, right? 16 years old. No, I'm sorry, Brian. But no, they're like, they're young. They're in their early 20s. It can be a little more aggressive because remember, when it comes to investing in the market, it's time in the market, not timing of the market. And sometimes we feel that fear of missing out. So he does say right here, it's going to be about a 2-year plan.
Yeah.
And so the pushback from the financial advisor is going to be, well, you're not going to have that compounding interest in that. But the power with real estate, remember, if you're buying a $400,000 or $500,000 home and you're using a 3.5% for FHA or 5% with conventional financing, a minimum down payment, even 3% with conventional financing is possible. You're also going to have that same compounding effect when owning a home.
Yeah.
It kind of reverses that.
Yeah, I think the couple things that stood out to me in this is the advice to not stop, but put a pause on the retirement investing.
Correct.
Because their point here, it's money you're saving anyways. You might as well use to buy a home, which is equally investing in your future. So it's kind of like you're putting it in bucket A versus bucket B, and bucket A has an appreciation that's connected to the market directly, and bucket B has one that's connected to the market directly / indirectly via real estate, which is also the place you're living in. Yeah. So if you're going to, pay a really exorbitant rental amount every month, well, if that's the equivalent of a housing payment and you can save for the housing payment, I totally see his point here.
Yeah.
And this makes sense because in the example of saving $1,700 a month for 24 months, let's say a young married couple, both contributing or combined contributions are $1,700 a month. Yeah. That's just over $40,000 in a 24-month period, which in most parts of the country, that's going to get you in the door.
Yeah. And, another thing that actually talks about here on the article is he also says, do not borrow or cash out your retirement because these do come with penalties. California, I think it has one of the lowest, where you get penalized. I want to say it's like 10%.
Yeah.
So we have one of its lowest, but that's not what he's saying here. What he's trying to say is, like, if you're contributing to it right now, and you're thinking of purchasing a home, just put that on pause.
Yeah, redirect it to another account that is kind of your slush fund, if you will, that becomes your down payment.
Yeah, because, the point that he was trying to drive is that although you're not going to be continuously, contributing to that, you still have what's in there basically writing out. So if you pull that, then you for sure have nothing compounding at all.
Yeah, you're minimizing the base that's already earning interest in its position. Just redirect it to somewhere else for a short period of time. And I want to emphasize that. Like, this is not the permanent solution because, again, obviously, because once you use those funds to buy the house, guess what? You can return to putting it back into retirement. And again, I know I'm somewhat surprised by this, but I'm also not, because if you take that long view, like you were just saying, that he also tells people to get in the market early, and then you can ride that you can afford for 2 years to save, because on the long timeline of 20, 30, 40, 50 years, what's 2 years relative to all of those?
Exactly. Yeah.
So there's a lot of catch-up provision, and at the same time, even though there's ebbs and flows in real estate, there's ebbs and flows in Wall Street, you're going to ride it out in one of or both of those parts of the financial world.
And another point that comes up to that is, like, if you stay in the house, let's say for a good 5-6 years, and then you decide, hey, now I'm going to sell, you can then take some of the profits for yourself and replenish back your retirement account, so down the line
it's not really a replenishment, right? Because he's not asking you to take money out or withdraw from it. So what the cool example there is he's giving a $40,000 example, and he's saying if you were to actually save $1,700 each month in 2 years, you'll have $40,000. Does that math?
Yeah, it's $40,800.
Yeah, there you go. See,
I actually did it before, so I didn't do that live. I was like, I better calculate this to know the number in case you did that exact thing right there. What is the total?
Because you're a mathematician.
40,800.
And so that's good advice. Seeing that in the beginning when I read that, like, Dave Ramsey, what you're gonna buy? But you have to read the article, because what he's all about. You're not going out there and getting into more debt. This isn't acquiring more debt. What this is showing you is save, so that you can get into that new debt. And it's going to allow you to just comfortably put yourself in that position. But here's the mistake, and I know we talked about a couple of weeks ago about the myths and stuff like that with VA. The other myth is misconception with people. Back in the past, most people thought you had to buy a home with 20% down. Yeah. And that's not the case. What it is, you can buy as low as 3%. You just have what's called as mortgage insurance. It's an additional payment on top of your monthly mortgage payment. It's all it is. And sometimes, depending on your credit score, that could be a very low payment.
Yeah, that might be the only way. And that's also where maybe you have to break from the advice in this article too, because the suggestion is if you can keep your total housing payment to 25% of your gross income.
Yeah,
I'm like, what? Well,
not here in California.
Most people, they're getting 45 or higher in a lot of cases. So I think that's I think that's the exception where we'd go, hey, you might have to break from that advice in the article. Up until this point, man, the suggestion in his blog is pretty solid advice. Again, given the current environment and the landscape of real estate, the affordability challenges, and just the way that property values are holding because of inventory issues, I can't find fault in his approach, because I know, or what I do know about him is that he's saying that within the context of returning to your previous saving and investing habits once you've accomplished the homeownership part.
Correct.
So if you're going to follow that plan, then 2 years is what, over a 30, 40, 50-year time frame? Not that much.
No, exactly. Yeah. And I go ahead.
One thing I just wanted to mention is at the end of the article, and I'm sure this was not on purpose, but I just want to make sure for everyone watching, it talks about, hey, there are some zero down payment options, and it goes on to talk about like USDA and rural loans. Guess what loan was missing?
VA.
Yeah, VA. So Realtor.com, if you could please go ahead and when you do an article, edit on that. Let's go ahead and add VA in there because it's actually more widely used than USDA. But who are we? Just three guys that talk about VA all the time.
And it has one of the least defaulted,
the lowest default rate of all loan types in the entire industry. So there's that as well. Anything else on this one, guys?
No, I mean, I'm just glad that he's saying, go acquire good debt.
Yeah.
This is good debt. Before he used to be like, even with homes, I don't remember him being,
It's like the only acceptable debt, but also have like an accelerated payoff, which, by the way, for people who don't know, we have a mortgage accelerator payoff calculator, which we can share with people. So if you are interested in paying your house off sooner, we actively show people how to do that. About Dave Ramsey, I just wish I could get into one of his brothers' restaurant, Gordon Ramsay. It's like they're not brothers, but I wish they were. That'd be super cool. We could interview them both at the same time over a great meal, talk about finances, right?
I'm like, wait a minute, what?
Yeah. Gordon Ramsay, man. They both yell at you. One's yelling at you about debt, and one's yelling about you using too much spices.
That's right. Sandwich.
Okay, I'm killing this segment. Next segment. So weekly demand surges 20% higher after interest rates dropped to the lowest since last year. Well, last year was only a couple months ago, so like that's not really it's not really like earth-shattering. But obviously, mortgage rates went down, and the mortgage application volume like spiked up because of that. So it tells me two things right out the gate. Number one, people are watching really closely, because if you see a week-over-week change of a 20% increase of mortgage activity, that means just kind of like one eye you're sleeping, the other eye is open, right? As we say. And the other one is clearly there's demand at a moment's notice.
Absolutely. I mean, Andy, it's all a fear of missing out. Like, what am I going to get? I get the opportunity. I might as well strike right now. I'll figure it out. I think that whole, cliche where people are saying, don't marry the rate, marry the home is coming into effect. You know what I mean? Now, because that 0.25% you're talking about here, we're in San Diego, right? The medium sales price is like $900 some $1,000. So when you're talking about a 0.25% difference, that's a huge difference in payment. That's like $200-$300 a month. That takes your debt to income ratio to another level where, okay, now I can actually afford a little more.
Yeah. I think also coupled with the changing insurance premiums, people might be looking for savings on that part of their life.
Yeah.
And I know that may be a little bit of a stretch, or might be a very small percentage of people, but hang with me here for a second. We were talking last week about how people's behaviors are actually changing due to insurance. Yeah. So if people's mind frame is getting on this whole insurance is going to cost me more, or I don't know what I'm going to do by my insurance because of the insurance carrier stuff, if you got to save $200-$400 on one side of your housing payment, because the other side's going to have that increase. I don't know how much is being driven by that, but I'm saying that could be a contributor to this whole one eye closed, one eye open on the rates kind of situation.
Yeah, of course. Yeah. Because it kind of balances it out, right?
Well, in addition to the fact that, if people are just looking to save because they have other expenses or their other spending habits are going a little bit out of control, there might be some of that. And let's be honest, if you bought a house in 2023 or 2024, your rates were already higher than they were in 22 and 21 and 20. So you don't have the lock-in effect, and anywhere you can save, you might be looking to, especially if it is tight.
Yeah.
Also, I mean, I feel the rates also bring a big more pressures because they get approved on their gross income, but they have to pay the mortgage payment on their net income. So that difference in the rate, whether it be an eighth, a quarter, or whatever it might be, that can make them or break them, because in their budget, they got approved for that amount, but really what they take home after taxes might not be enough to cover that payment in a comfortable way where it still allows them to do what they want to do. So therefore, they have to compensate, bring the purchase price lower, or figure out another way to get creative.
Yeah, no, absolutely. I like how it says a sharp drop in mortgage interest rates finally lit a fire under loan demand.
Yeah,
like it does. It makes a difference, But we see all the indicators, everything that's going on. We still have unemployment at its lowest, 4.1%. Is the last time that I saw that it was that it mentioned that. So 4.1%. We have these tariffs coming in. for Canada that got implemented with Mexico, Canada. We have these tariffs with China. So we all could have sworn inflation is going to get higher. So why is the rates, how is it that they've come down? So it's like, it's hard to understand the reasoning now. Are we really saying that Trump, because I know he said he was going to told the Fed, Uncle Powell, reduce the rates.
Yeah, it's like
is that what's happening?
I call that podium pressure, right?
Yeah. Does he have direct? Does he have direct influence like that?
Everybody knows he does not.
But isn't it crazy?
Like, I feel like
it's the market's reaction to those other things that are happening. So it's the market's reaction to those things. Sorry if I'm cutting you off there. It's the market's reaction to those things. So as there's a saying like as the bond market goes, so does the global politics, and there's a lot behind that. Yeah. And mortgage-backed securities broadly follow the 10-year yield bond market, and so if that thing's going down and going lower, well, so are mortgage rates. It's going to follow it on the way down.
That's what we're seeing.
And if they go up, it's going to follow it on the way back up. Yeah. It's like a trail. It's like a coattail.
I mean that, and you follow that very well, Andy.
Well, I'm a dork.
Big nerd. But you've been seeing that drop.
Yeah. Well, the thing about it is it was almost telegraphed on the chart because ending January coming into February, like, oh, it got rejected up at this high, so it's going to absolutely have to go low just from a trading perspective, the bond pressure, and then all the global political stuff, tariffs, the war stuff in Ukraine, the Israel-Gaza stuff, just the wild things that are happening with Doge, like all that kind of like dogpiled, and the market was all and like really started tanking in February. It was crazy.
Yeah, I mean, it's good to see, and I think there's nothing wrong with even our rates just being in the sixes.
Well, I think they're normalizing that for people.
Yeah, and it should be where people could adjust because the sevens, it was crickets.
Well, yeah, that's going to cause unintended harm to the market, just as elevated prices do from an inflationary perspective, too.
Unintended harm.
And so, but at the same time, what I think you're going to see what I think we're going to have to see, whether or not it happens, is whether it brings sellers off the sidelines. I think sellers will still have a little bit of hesitation, even though mortgage rates are down, because if they did buy in 2020, 21, or 22, or they already owned prior to that and refinance in those years, they've got those handcuffs, man. They got a 2.75, 3%, 3.25,
even a 4%.
Like even 4. I know, even 4. If I call someone right now, it's like, hey, I'll get you a 4.9. They'd be like at the door. They'd be lined up for miles, right?
Yeah. Oh, yeah, 100%.
Right. Let alone 3.5, 3, 2.5, whatever. So
even a 5 will start, bringing people back in a lot more than we see. But
so I'm just saying, I think that's part of what we have to just watch and see what happens, regardless of all the international, global political kind of stuff, even a lot of our national politics. Like, we just have to see what the behavior is going to be tilted and shifted with the market going that direction.
I like that. I like that you broke that down.
What I've seen is it comes in waves. Like, there's weeks where the pricing of rates are down, and then inflation data comes up, they come right back up. But I feel that's why you have to be even more proactive during these times, because you have to strike when the time is down, when the waves are low, because they'll come right back up, and then you have to wait for it to recalibrate, go right back down. But I think there's going to be pockets, waves of high rates, low rates. But if you're not in the market consistently, if you're not actively on the market, then you're going to miss out on those opportunities, and you're always going to be playing catch up until you solidify yourself into an approval and start moving forward.
So I'm going to bring back something I thought of when I was preparing for today's show, reading this. Do you guys remember in the spring of 2020 when COVID first happened, and it was like, everybody go home, 2 weeks to slow the spread, flatten the curve, all this stuff. And you had a conversation with Ron that you shared with us, and Ron was like cool as a cucumber, like, hey, guys, it's going to be okay. Yeah. They're going to figure something out, and like, this is actually going to work out for our favor. Just hold tight. And he sent like this whole company-wide message, right? Yeah. I remember this. And the number here on this report is similar to what happened back then, and I'm going to go to it right now, which is 83%. There was 83% higher than the same week 1 year ago. Dang. So put your mind in spring of 2020 when there was like this absolute screeching halt to the market, like no one did anything.
Yeah.
1 year later, what happened by spring of 2021? Everybody's refinancing. Everybody's trying to move. Everyone's trying to buy a house. Everyone's qualifying, and rates are super low.
Yeah.
And you saw this same type of like statistical anomaly of this massive increase of mortgage activity because of that. Turns out Ron happened to be right.
Yeah.
But that's the last time, or the most recent time, when we saw a statistical anomaly that big.
Yeah. Where are you, Ron?
Yeah. Well, and it's in times like that, when you're really close to like, oh, there's this problem, and it's just being like forced and fed to you constantly everywhere you look and everywhere you talk. You kind of go, okay, well, what's that mean for us? Like, how do we localize that as a business and as a person who's inside the company and inside this industry? And you're like, well, I have no idea what's going to happen. And then he's been there for decades, and he's like, no, it's going to be okay. We're going to figure it out. Like, part of me goes, well, yeah, you're the boss. You're supposed to say some
You're
of that
supposed
stuff.
to that, yeah.
You're
Keep
the
us
owner.
at ease.
Everything's going to be okay. Don't worry.
But there's also that like seeing through the thing that I'm like, I think we really benefited from that a lot during that time. Yeah.
It was a crazy time.
Yeah.
I do like here, what it states here. Mortgage rates were clearly the culprit. The average contract interest rate in the 30-year fixed rate mortgage with conforming loan balance. I like how they use the conforming. Obviously, 806, 500 or less decreased to 7.3 from the 6.8.
6.73.
6.73. Yeah, 6.73 to the 6.88. I mean, that's not a 0.25%. That's just a little bit. That's enough for people just to have 20% of people just to start getting active. Like that's crazy.
Yeah, and so on our side of things, like that is more representative of what happened on the actual rate side. But on the pricing side, where it comes down to buying your rate down or how much credit could go towards a deal, there was a much bigger change on that end of the business than there was on the front side of the actual posted rate.
Yeah.
So I think there's more of this to come. Is my kind of like end all be all for this. I still think there's gonna be more mortgage demand because now they've seen it happen. There's going to be this expectation, when that comes back, like a merry-go-round, when that comes back around, I want to be ready. Yeah. Oh, well, if that's going to happen again by the spring and I want to buy, or the summer, I want to buy, I think that's going to shift some behavior into that direction. I think we're going to continue seeing an increase in mortgage applications coming into the spring.
Yeah. You don't have to buy now, but you do have to be ready.
Dude, yeah. Even if you're not buying now, get ready now.
Yeah. When I saw that, it just prompted me to go see. I saw the 806, and my key word was, the key word was less than that 806. Well, in San Diego, when your medium sales price is $949,000 according to Redfin, that equals to about $704 a square foot.
Yeah, that's
pretty crazy. Because that rate, remember, people. That's for loan amounts at an 806 or less. When you're in the 900, you're talking about a 7.25%, 7.5% rate. That makes a huge difference because your loan amount's larger, and therefore now your payment's just that much more.
Yeah. Yep. So this is going to dip into the next thing, guys, because it does relate to one of the largest categories of our demographic here in the U.S., which is millennials. Millennials are moving to 5 surprising states. 5 surprising states for affordable housing. They are Nevada, Tennessee, Texas, Georgia, and Ohio. Are we surprised?
No. What I wasn't surprised to read, and it's something that we've all been aware of, is that if you notice on every state or every place that they're moving or migrating to, one of the biggest things is recreational and work. So as long as their experience seems good, it's gonna be good, or it's tied into their life experience, they're okay with moving it. And a lot of it had to do with having accessibility, being able to have a good paying job, being able to have enough money, and having the experience that they want while being able to.
Yeah, I just think they're saying, hell no. I'm not going to wait till what? The average age of buying a home now, that went up to 50-some years old.
Yeah, and it makes sense because
or 40.
What are you talking about? The average age of the first-time home buyer?
Yeah, first-time home buyer. What was it? 48, 49?
No, it was 35. But that's actually in this pocket.
Increased. It's actually increased higher.
Yeah,
it was 38. I think last year. This year it came out to even worse than that.
But that's all. That's in that same pocket. So the pattern I saw here about that age was I think in Nevada. What I marked. Yeah, so I highlighted this. Nevada, the median age is 40 in Reno.
Yeah,
and then you have. In Tennessee,
35.
It's 35, and in Texas, it's 36.
Yeah.
So it's kind of like the median, and it's also right in line with that national average for first-time home buyers. And the millennials are going to be the biggest batch of first-time home buyers in this next 10 years because they're in this earning age. Yeah. They're in this spending age and this life stage where it's I need the house because I'm going to have kids or whatever, but comes that behavior along with it, like Brian's saying, of I still want to have experiences. I want to be able to go places. I want to have a high quality of living, lowest cost as possible. And I think this group is economically way smarter than maybe ours was. And I'm going to tell you.
Oh yeah.
I'm going to tell you why.
In some ways, I do.
There's differences, but there's some ways maybe ours is more
wise
and yours is more wise. But here's the thing: a lot of these guys are saying that they want low cost living, low taxes, affordable housing, entertainment, stuff like that. But they're looking at the overall experience, and they're migrating because they're looking at the totality of everything, not just the house is the end all be all. So it's the awareness of things like taxation and whether there's income tax or not, or whether your property taxes are fixed or if they're going to be changing every year. Like that awareness is way different than what was coming from our
absolutely.
generation.
All they talked about was affordability, and they talked about, well, how is that going to become a thing, affordability? Well, when the home price is much lower and we can fit my whole family there, and with growth, that's one. But the thing, the common denominator of all of these, it was job opportunities and future growth, right? They're looking at these things in a different lens than we did. Before I looked at it like, dude, I get to buy a house right here, and I get to party all the time in the Strip. Like, this is great.
Heck yeah.
And if I had a good month, I'm just going to go in bed and hopefully, bet on red, and hopefully I just double my money, right? These guys are just totally looking all different, which is great.
I feel like the millennials are either in a position where they have a high or decent paying job, and a lot of them, choose to work remote. So that gives them a lot of the accessibility to be able to move places other than their home city, knowing that they could still work anywhere else, save some more money. And if they're in a high cost area, they're like, hey, I could book it to someone else, still get paid what I get paid, and make my dollars stretch more.
Yeah.
Well, I did do a little research in preparation because I was wondering, okay, what are the top reasons why millennials would be migrating? And you're already mentioning some of them. There's number one, seeking affordable housing. Number two, a preference for suburban or exurban living. Remote work flexibility, which I think, again, the dynamics of coming out of 2020 really shifted everyone's attention into that. I know there's a big clawback happening at a lot of places where, hey, return to work, finally now happening. But I think the flexibility part is obviously why it's listed here as number three. The fourth thing listed was desire for lower cost of living, which we talked about on multiple variables, not just lower property tax, but even places that have no personal income tax. And then climate and lifestyle preferences, just wanting to be in a nice place.
Yeah.
And wanting to be able to go do stuff, be able to afford to go do stuff and create experiences without just being completely house poor all the time.
No, totally. I like it here too that some of these millennials actually want to work in an office. This whole just staying at home thing is not working out. And I'm thinking now I'm just getting distracted because it's like, office work setting 4 to 5 days a week. Like, that's what I was like, okay. I was actually surprised by that.
Yeah.
Because I see Ashton and Dylan, they like to be at home.
They do, but they go to work, don't they?
They do.
They go to work, so they come home. So it's weird. It was like the whole like trad wife thing was trending like last year, right? Where it's like, but I think some of those traditional things, the millennials or younger generation,
trad wife
coming back to like a traditional wife, like a stay-at-home mom and raise the kids. I'm not taking a position on that. I'm just saying that I think some things that are traditional in our culture are being held on to. As much as things are changing in one way or another, I think there's some traditional values and some traditional things that they're looking at and going, you know what? I see why my grandparents did it that way, or I see why my parents lived it this way, because not everybody's cut out for work at home. Some people can't turn that off. And so some people need a place to go and a place to leave so they can come home and like rest again. Yeah. And then be ready to go back to the place.
Yeah,
and,
you learn to appreciate your kids better.
And not all workplaces are like that. You're not going to go build trucks at home. Like if you work at the factory, you got to go do that work over there. So
no, I get it.
Me over here talking about factory work. What am I talking
but
what
it is cool to see, identify the 5 states that people are going to. Some of these sound fun, like, Nevada, Tennessee.
I heard Tennessee is fun.
Yeah.
Tennessee's awesome. Yeah, I love Tennessee.
And then they got Texas, Austin. We have
keep
one of
Austin
our friends.
Weird.
Yeah, keep Austin weird.
That's right. Austin's a crazy place because it's like in the middle of Texas where you have like a lot of like there's just some like vast open expanse, and you get to Austin, it's like this like booming city. It's crazy.
Yeah, they say it's close to San Diego or something like that.
I might be like,
it does feel a lot
except
that
for
way.
the mosquitoes.
I might be biased because obviously I've lived in San Diego my whole life, but I just feel it'd be very difficult to leave here any other state because of the climate that's so good, everything around, like, and then you go somewhere else. Oh yeah, it's a lot lower, but I hate mosquitoes. I hate this heat. So it's like, give or take.
And those are facts, Brian. Those are facts. We actually have a friend that that's what in the beginning, it was all good, right?
Yeah.
It's like, it's like the honeymoon stages. Right?
I can get through this. It's fine.
This is great. And then 2 years later, like, okay, I get this. Now I can't put lotion on, and I don't dare to put cologne on because the mosquitoes are going to really get me, Oh, and then I'm going to go in my pool and I'm going to put a freaking, a net right there so nothing comes through. Like, oh, no.
Yeah.
Yep.
I'm sorry we battled that.
It's that personal prioritization of things. Like there's some things
or
we're willing
we go
to deal with and some we're not.
We go in our pool and we find an alligator or a snake in there. Like,
find an alligator.
We don't do all that.
And San Diego's like, oh no, it's summer in the morning, but winter in the afternoon and fall midday.
Yeah,
like what?
We're gonna catch
we know Kaylin when she went into the pool or fell in the lake, she didn't even want a paddleboard over there.
We're gonna catch so much hate in the comments.
Went from Texas over to Florida. It's like
yeah, with the Florida.
Yeah, how'd I get a paddleboard over here? Because there's an alligator gonna get me.
You skip states without even missing a breath.
I just had to go everywhere, you know.
Oh, man.
I am everywhere now. So
well, let's talk about sellers, guys, because we have to wrap this up. But this new survey came out that said 90% of homeowners are worried about selling. Now, before we get into the conversation part, I want to go back and remind everybody, if you missed our episode 101, in episode 101, we talked about the survey that came out then, which said 48% considered selling in the next year, and
that's right.
36% said they'll sell in 2 to 3 years. So you have over 80% of people saying they're going to sell in the next 1 to 3 years, and now you have 90% saying they're worried about selling. Now, my question is this just semantics? Because this article is saying worried about selling, and the other one is saying considering selling. Is this just a war of words, or are we having this massive clash of confusion about what sellers are actually trying to do?
I don't think it's confusion. I just think an article has to pinpoint whatever their discussion topic's going to be. Here, I don't think it's saying that. What it's really, the way I interpret it, it's like 90% of people are considering selling, but they're fearful, right? What's the outcome going to be? And I like that it breaks everything down in percentages, because it is. Because you know what? I would love to sell. Not a problem, because I'm going to get a lot of bang for my buck right now. But my fear is, what if I don't find that other property that's going to suit my needs, and then I'm just going to have a higher payment? So I kind of see both views on the article. You know?
Yeah, I totally understand that, because they did, of these 1,000 people surveyed, they did kind of segment what their responses were and for why. Stress of sale was the top reason, 42%. High cost of selling was number 2 at 40%. I thought, honestly, it would be this next one, inability to afford a new home.
Yeah.
I thought that would be the number 1 reason.
Yeah.
Because commonly what we see, or what we're told, or what we overhear, and then what we read online is people don't want to sell because they want to break from their current rate. And then the cost of moving to the new place would be potentially higher, even if they have the same loan amount. Yeah. They could take their equity and dump that as down payment, but because of the rate, their cost would be higher. So I honestly thought this would be the number 1 reason, and it's not. It's the third.
It's crazy, right?
Yeah. Look how the top one is just the stress. So it's literally just the thought. The thought of having to put my house, taking the action, actually doing it, that in itself is the biggest obstacle.
And you know, there's just so much. There's just so much information out there that creates a lot of confusion to people, right? You got the Zillows, Open Doors, you got all these companies that all buy your house for top dollar, and they do. But what people don't know is that these companies, if you open their actual net sheet, you're going to see how much they take.
Yeah.
You know, I just had a client that actually put it through Open Door, and they were selling in Poway for 2.2. I can't disclose names, but they charge over $140,000 just in fees. So they thought they were going to walk away for a certain amount, but they were but they need it. They ended up buying another homes elsewhere, and their business, they also needed help there, and they only owed $600 and change. So they're like, we're just going to take the L and move forward.
Whoa.
You know, the property got just back in escrow for 2.2.
Oh, no way.
Yeah,
really?
yeah. So it's all in the net sheet. It's all in you got to see the information, because a lot of times the sellers, it depends where your need is at. It depends what your situation, financially is at. And sometimes we just need to cut our losses and move on, and that was this case. So I just think there's a lot of these platforms out there that are giving so much information to people. It's like, am I making the right choice? Am I using the right person? Am I pricing it right? It's just a lot. It gets overwhelming unless you have the proper dynasty team that you feel very confident and it's been vetted, that they're going to take you to that next stage in life.
Yeah. Wow, that's fascinating. I didn't know about that.
Yeah.
So they had actually sold it to Open Door at $2.2 million, and it's now back on the market at the same price.
At the same price, but they ended up buying it for $1.8 and change, and it cost them $140,000.
Yeah. Okay. Wow.
So on the flip side of that, I read right here that 43% confidence will come back for selling when 43% people follow a trusted real estate agent.
Mm-hmm.
So that trust factor is a huge thing, and it makes sense because it's like in a tough market, like you don't want to go with just anybody. Yeah. In 2020, it was easy to just go with anybody, but now in a tough market, you actually need proven results, proven strategies, and things that are actually going to work. Not just like, hey, I'm going to put the house, hope that it gets exposure. But the next one was 45% if they already had a secured home. Basically, like they started shopping before they even sold their house and said, hey, I found the house. Now I have the confidence that I have something I want, so I can't put my house on the market.
Yeah.
The
other one that I want to read it here is, one of the most significant fears for current homeowners is being forced to accept a lower than expected offer, with 85% of respondents saying they have some level of concern about being pressured into a low deal. I really think right now, being that this article is being written during these times where interest rates are, higher, and affordability, 2025 has been its worst, in X amount of years. I think it was like 24, 30 years.
We said the worst in 23. We said the worst in 24. Now it's the worst of the worst.
Correct. And again, we've already started at its lowest sales of homes. This is like going into the fourth consecutive year. You know what I mean? And so I think a lot people don't understand. It's not that it's a lowball offer. It's just the current market condition of what's being presented to you. So for instance, I'm going to use that example of Poway. The home was at 2.2 mil. Home was listed back in October, didn't have any activity, had people going in, but no offers. So is your home really worth that 2.2?
Yeah, fair point.
But you're thinking that might be a low offer just because the other home sold for 2.2 and yours happens to be larger. We don't know how it really looks inside or how people are looking at that property.
Yeah.
So I think it brings a misconception to people when you have higher comparables in the area. You may think it compares in the square footage, bedroom and bath count, but a lot of times it just doesn't conform to how that person's going to feel emotionally, that attachment to that property.
Yeah.
And remember, the value comes from a buyer wanting to present an offer for that. So if you don't, even if there's comparables in there and people aren't putting an offer, then that's not the right purchase price.
It's a very emotional and biased opinion. It's like, my kids are the cutest.
Oh, yeah. Today we had a great guest, actually.
Yeah.
And he was telling us he was an 18-month escrow on that castle that you brought up.
Yeah.
That's a perfect example. Some people, he had nobody wanting to buy at that price. And then all of a sudden, when it fell out of escrow, the month later, he had 4 offers. And then he has another client right now that's looking for the same thing, but you can't replicate a castle, right?
No, you can't. And the crazy thing is that maybe that $10, $20, $30, or $40,000 drop, that's somebody's magic number. Maybe they like $10,000 lower. Okay, that's now I could actually go in. Whatever it might be, it might just make a little bit difference if you drop the price. Yeah. It's like, okay, now I can afford it.
Yeah. So my advice is, don't stress on what you're not going to get. Just stress on what's your bottom line and focus on that. And if you're able to get that, good. And if you're not, guess what? You have a roof over your head.
Yeah. And unless you need to sell, it's okay to take your house off the market. Like if it doesn't work out the way you want, just don't list it anymore. Take it off the market.
And then
it's okay.
The other thing is get feedback, right? Like get the feedback. Have the person who's working and selling your home obtain feedback. Reach out to the people that came and say, well, what can I do different? And maybe you take it off for a little minute, for a few months, and then you put it back on again, and let's just wait it out.
Yeah. Yeah, I think there's a lot here, and it doesn't always just distill to only the personal agency of the person. I mean, it does because it's their house. But my point is, there's the variety of reasons they may want to sell are very personal. They can be general in a survey, and that's fine. But again, it's still a survey. I don't know how many of these people are actually going to go and sell this year or not, because they're just giving answers to a question. The consequence of me answering the question is just I answered the question.
Yeah.
It doesn't mean I'm committed to whatever the answer I gave is either.
Yeah.
So I wanted to be, before we cut from this one, I just want to make sure I mention something that I thought was interesting, because for the aforementioned nerdness that you guys like to call
Professor
me,
X.
is the national median of home sales, like the price, the time it takes to sell homes. So the national median is 37 days. So fastest selling and slowest selling homes, the median is 37 days. The slowest 10 cities have a median sales listing time frame of 57 days. And then the quickest, it's 21 days, which is, I mean, there's a huge, like a month and a half difference between those two numbers almost.
Yeah.
That's crazy. So, if you're in one of these areas that has a really slow overall selling time, just be ready. These cities were Miami, Austin, Jacksonville, San Antonio, Birmingham, Alabama, Nashville, Pittsburgh, New York City, Phoenix, and Chicago. If you are a buyer in one of the fastest selling areas, get approved right away and then be on it the second those houses come on the market. That's going to be Grand Rapids, Michigan, Buffalo, New York, Seattle, San Jose, Richmond, Virginia, Boston, Indianapolis, Sacramento, San Diego, and Fresno, California.
Oh, dude, I saw Fresno. I was trying to do all the California
15
ones.
days. Look at that.
Yeah, isn't that crazy? Seattle, 15 days. Grand Rapids, Michigan, 13 days.
That's kind of...
overall fastest in the entire country is Grand Rapids, Michigan? What's going on in Michigan, guys? I feel like we got to figure that out. I got to do more notes. I have no idea what's going on in Grand Rapids, Michigan.
I'm going to take a guess. It's going to be there's not a lot of inventory there.
Well, yeah, probably.
There's not a lot of inventory.
Yeah.
And
or people are snapping them up for cash because you can get them cash out there. It could be a lot of investors.
Yeah, and New York, what I'm seeing in New York City, 55 days, I also feel confident it's just taking longer. It's because of the
bureaucracy. Purchase price, bureaucracy. There's some places that just take longer to close.
All the other ones like Miami, Austin, we already know they've experienced an uptick on their inventory. I want to say like Texas was like 44% more inventory than last year. So, Florida, same thing. Things are happening.
Yeah.
And we're starting to see more people saying, okay, I was in Cali. I got out, I was thinking it was pretty bad over there. I'm going to go back.
You're probably right. There's a really strong correlation between inventory and the days on market, where a tighter market's going to have fewer days. And of course, a market that's flooded with inventory is going to have more. I'm curious to see what happens with Washington, D.C. as we get into like April and May. I saw that map of like all those listings that popped up and I was like, whoa, crazy inventory spike in January. So I'm not going to dig into that at all, but I'm going to keep one eye on that one. So, guys, tell me, what was the favorite part of the show today for you, Brian?
I think the Dave Ramsey's article, just, his different perspective than what we're used to, I think will be very refreshing to a lot of his followers, a lot of the people that he serves. And I think if they take that advice and they execute it correctly, they can find themselves in a house in 2 years.
Yeah. Mine was the last one. The sellers, don't stress out.
Yeah, sellers. Don't worry, be happy.
You're in the driver's seat.
That's it. You're on the driver's seat. There's multiple options. You have full control of it, of what you want to do. Don't put yourself in a position where you don't think you have options when you do.
Yeah. Mine is millennials. I am very intrigued by this like up and coming generation of home buyers because they are broadly going to be probably the largest subset demographically of the people we do new purchase loans for. And it's very curious to me as we've gone into a new season of being able to lend across the entire nation at the same time that these people are moving out of the places which are our backyard, like leaving California, leaving the other areas that they're going to these other places, which now we can finally help them, which we couldn't have before. So I'm encouraged and excited by that. And it's also very evident to me that as we continue talking about behavior, I bring up behavior all the time, but as we continue talking about that and then we see more that kind of supports that, it confirms a lot of our suspicions and things we kind of see in a micro kind of way. And then we kind of see it like in the region or the state. And then now you're seeing it at large, an entire generation and a demographic. I think there's a lot to come from that conversation with millennials. Yeah.
No, I agree. They're very clever in everything they do. They ask very good questions. I'm going to say right now, I work with the majority are millennials. Yeah. And they're just trying to figure out if I'm going to say in California, how do I even utilize the whole EDUs? They're asking good questions.
The complete approach about housing with millennials is completely different than the other generations. We've been around 20 years now, and their approach is completely different than it was, than people we sat down with 10 years ago, 15 years ago. They look at it completely different, and I like it. Much more savvy. Congratulations, Brian.
Thank you guys.
You're in the club. You're on the bus.
I'm like, I think I know a thing or two about millennials.
No, but it is different. It is a lot different for you guys buying a home nowadays than it was for us.
Yeah.
Did we have to get that clever at times? We didn't. The opportunities were there. We just a lot of times didn't know how to put it together or take advantage of it. Well, I think millennials now are looking at things more being an opportunist.
Yeah.
I think when you have more options, you can make better decisions. Before there was only one option or two options, so it's kind of like, different always. But nowadays, I mean, a lot of options could also be bad.
Yeah.
And it also,
what's crazy is in my time, our parents, my mom was like, don't buy a house. You don't need to. Right. And so now I think, me as parents is like, my kids, go buy a house, go invest. It's a very different conversation.
It's funny because you mentioned earlier, you're like, oh yeah, you guys had ChatGPT. I was like, you guys had ChatGPT. Like, what your uncle told you was like, hey, my tío told me it's true.
Yeah. Yeah.
ChatGPT. That's the first time I've heard of that. We have to end there. You guys, if you have not used ChatGPT, you can use ChatGPT. Both of them will give you answers. I'm willing to bet they're going to be wildly different.
Very.
Thank you for watching the Mortgage Heroes Wiki podcast. Remember to subscribe to the channel, like this video, share it with someone you love and care about, who you want to see win in mortgage real estate. You guys, thank you so much for an awesome show. What a fantastic ending. I can't wait to put this one on social. And if you're watching this for the first time, also check out our playlist called Friends of Mortgage Heroes, where Will, Brian, and myself talk to our friends in and around real estate about a wild variety of topics, and it's absolutely fascinating. We have a fantastic show coming up this week on Friday, so be sure to tune in on Friday, May 14th, to check that one out. Thank you all for watching, and we'll see you again next week.
Betrayal, action.
Yeah. If you like this video and like to subscribe, click here. And if you want to watch other videos, click here.